is aware that it is not easy to fundraise right now? Let's see. That's a much better showing of hands.
Finally.
Thank you very much. Well, our panel of experts here is going to share some tips and observations about what it means to be financing innovation during a difficult market cycle. So we'll start with a quick round of introductions. Then we're going to have a very fluid, exciting, fun conversation. I'll start by introducing myself and then turn it over to the panelists. My name is Jennifer Friel Goldstein. I work at Silicon Valley Bank. I hope you've gone to our lovely lounges as part of this conference. I run startup banking, which means I get to work with all of our early stage tech and life sciences companies. And I do have a fun question I am going to ask all of my panelists to also answer, which is, what is the worst job you've ever had? And I will start. The worst job I ever had was working with cadavers. Okay, we're gonna move on. JJ, you are up.
Thanks, great to be here. Thanks everyone for having us. My name is JJ Desai. I have the fortune of being a shameless promoter of Miami. I love living here and have helped to build a company here in Miami, so we'll give that a round of applause. Super proud of what eMERGE has done, and it's a total privilege to be here with you guys and on stage. Thank you so much. My day job is helping to lead a growth stage medtech, biotech company that's headquartered here, and then have the opportunity to sit on a lot of different boards and invest and build portfolio companies, and all in healthcare. My background's as a physician, as a founder of my own companies. And I will just second that it's probably the elephant in the room is the most challenging fundraising environment, certainly since I've been doing this for the last 25 years. My worst job was one of my first jobs, actually. I was a junior, I'm born and raised in Southern California. I was a junior lifeguard. It looks really glamorous, but when you're a junior lifeguard, the junior part is the most important to look over. You kind of get the worst part of the beach, and you're stuck in a wooden tower, and you got to get there at 5 a.m. every day.
Yeah.
So being at the beach isn't always
At least
as
you're on
nice
the
as it
beach.
sounds, yeah.
At least you're on the beach. That was great. Thanks.
All right, I hope everybody's great. My name is Saxon Baum, and I'm a partner at Florida Funders. Florida Funders is an early stage venture capital fund. We invest late pre-seed through early Series A, companies in Florida, in the Southeast, and beyond. We focus primarily on B2B software. We do a lot in fintech. We do a lot in digital health, ed tech, cybersecurity, sports and entertainment, and then e-com and e-com enablement platforms. My background is I'm a former entrepreneur. So I built and sold a venture-backed company to start my career. And I will say the investing side is a lot less stressful than the operating side. Although it is as hard to raise money as a VC right now as it is as an entrepreneur. And we'll get a little bit into that. The worst job I ever had was, there was a summer I was living in Boston, and I did not go to Harvard, but I was working at Harvard, taking kids' furniture from their dorm room to their parents' car. And as you can imagine, with no elevators, going up and down the stairs in 100-degree weather from 7 a.m. until 7 p.m. was not the most
But you were in great
job.
shape.
What?
You were probably in great shape.
I was in great shape,
There you go.
exactly. There's always a silver
positive.
lining there, right? But happy to be here.
That's great.
Well, thanks. I'm Yousuf Khan. I'm a general partner at Ridge Ventures. We just raised Fund 5 last year, so we're happy about that. We're a $180 million fund. We invest in B2B software, whether it's enterprise software or selling into SMBs. We were early investors in companies like Fastly and Braze, both of which went public, and other companies like Crux and Discord, which have done very, very well for us, basically. My background, I'm one of few people in venture who is a former operator as a chief information officer and a chief information security officer, so I've spent 20 years buying software, building software, destroying it, architecting it, and then some. I was a very strong proponent of a number of early stage companies where I was either an early customer, companies like Datadog and Slack, and other companies where I became an early advisor. Most notable of those is Zoom, which in 2015 was less than a few hundred people, and of course had gone on to do what it did. So phenomenal outcome there. I spent several years as an operator and decided to make the shift into venture in 2020, joining Ridge. My worst job was, I actually I'm like the more in-person, in-office kind of advocate. But back in the day, I was given this job of photocopying files. I'm pretty sure it was the most kind of character building experience I've ever had.
See, even you found a positive.
Yeah, so yeah, it's
building.
quite an
I'm going to use
experience.
that with my children when they complain about their jobs. So that is great. Well, we're going to open it up to some questions. Saxon, I'm actually going to spend this first one your way, and then everybody can chime in here. Can you talk to us about the importance of network building, specifically how people should be thinking about building networks, leveraging networks for fundraising when times are tough? And then maybe if people have any great examples they've seen of people leveraging their networks in creative ways.
Yeah, absolutely. I mean, I would say I've never been the smartest person in the room. Hopefully I'm not the stupidest person in the room, but I really have never been somebody that was great in school. But one thing that I've always been really good at is building authentic relationships. And so the reason that I've been able to, in my opinion, achieve what I've been able to achieve, which is not that much compared to these two, but been able to achieve what I've been able to achieve is because I feel as though I'm really good at building relationships and building networks. And in my opinion, when you look at venture capital and you look at entrepreneurship, really right below, I would say, a great team, great talent, and a great product is what's your network? You know, who can you call? Who can you get on the phone with? Who can you go and see in SF, in Miami, in New York that can really help you? And so I don't think there's really anything that's more important outside of the business when it comes to fundraising outside of your network. And how do you build a network? And what is a network? Is it friends? Is it family? Is it professionals? Is it people that you meet that day? It's really all of the above. And it's how you leverage those relationships. You never want to be transactional. You never want to say, hey, what can you do for me? What's the quid pro quo? That's not the answer. It's how do you build authentic relationships that then turn into a very authentic network? And it grows organically. You keep on getting out there. You keep on meeting the right people. You keep on doing the right thing, and you do right by other people. You don't expect everything to come back because you know some things won't come back, but you just do it. And then inherently, maybe 5 years later, something great does come back, right? And I'm sure there's countless examples of where that's happened to everybody here. You know, I've had LPs in our fund that I met in 2015, 2016, and it wasn't a fit for them then. We had a great conversation. We had a great night. We had a great dinner. We shared an experience. I get a call 7 years later, and hey, now it's time. We just sold our company. Now it's time to invest in the fund. So you never burn that bridge. You always keep those relationships, and you keep it extremely authentic. You know, one thing that I would say, and my dad always talks about this, is when you're in a conversation, especially at a conference like this, you need to be laser focused on that conversation. You need to be talking to that individual. If somebody comes up to you and they want to bombard that conversation, that time's not right. They'll still be there, let them go. Enjoy your conversation with that person because that's how you're going to build that authentic relationship. If you're looking around left and right, what's going on, who's here, who's there, it's very obvious that you're not engaged in that conversation and you're looking for what's that next thing that you can talk about. So for me, relationships and building network is truly the most effective thing that I've been able to do in my career. And once again, I just think it's about doing the right thing, meeting the right people, putting yourself out there, going to networking events, traveling the country if you can, and always when you go to a place like New York where I don't live, or Los Angeles where I don't live, go on LinkedIn, look who you know on there. Go on Instagram, look who you know on there. See who you can link up with while you're there, because inherently something great is going to come out of it.
I love that.
I'll just to add, because you said some great pearls of wisdom there, and I think reinforcing them. There's an interesting statistic, and I think it's really powerful. In seed and Series A, 98% of investments come through direct or first-degree relationships. I cannot reinforce the power of that. And in my own experience, getting those initially is the hardest, but then they trail every single deal, every single company. There's the same core, and there's truly 6 degrees of separation. And if you go into B2B, SaaS, or if you're in healthcare, it gets even smaller in those worlds. And then if you nail it down to seed or Series A or Series B, it gets even smaller. And when you're at the growth level, it kind of does that. So personal relationships, being present when you're first meeting people, do not pitch your company the first time you meet somebody. It's just, unless you're in their offices to pitch them, it's not the right way to build a relationship. And the other thing that I learned, before my current operating company, my role was to build a global network for Johnson & Johnson at the earliest stages. And we did that by building physical spaces in something called J-Labs. And the one thing that most people told me was just showing up was like the most important thing. they're in your academic centers and things like JLabs, at CIC, at different incubators and accelerators. There's so much programming that it can like seem somewhat audacious, but just go, just show up. Even if you just show up, learn, listen, and you don't talk to anybody, but you come back, you will inevitably make a connection that will help in your funding or in your operations as a talent kind of recruitment down the line.
Well, and you know how it is. You see somebody a few times, you start building that rapport, you build that relationship. You might not talk to them the first time, but I guarantee you second or third time, they're going to come up to you or you're going to go up to them.
I think the other thing is referenceability is very important, right? And so one of the things that is not spoken enough of is when you are a founder building a company and you're looking to raise money, yes, a VC will basically meet with you to say, okay, I would love to hear about your company. But ultimately, the way they reference you and being able to triangulate opinion is very important. The reality is that the more people you meet, there'll be a bunch of people who will pass on your investment, and there'll be a bunch of people who will be excited, and then there'll be some people who won't meet you. But the ones who do, you know, there is a tremendous amount of collaboration that goes on, being able to exchange notes about ideas and founders and companies. And that makes a huge difference. What you want to be able to get to, especially if you're a founder, is triangulation of opinion. And that only happens through networking. The fact that you are able to meet the right VCs who are investing in the space that you do, it's quite likely that other VCs, because they talk quite regularly within each other, are able to exchange notes accordingly. And that may not be at the existing stage that you're raising it, may be at a much later stage. And so remember, there's an aspect of networking which, of course, is good in terms of building relationships, but it also has a purpose in terms of longer term. And I think Saxon basically mentioned that. Building a relationship with a potential LP, all of VCs involved, we're doing our fundraising as well. Like those are long-term relationships and having multiple touch points, having multiple pieces of information. But I know for a fact that they will be referencing us through people that are common connections, and that's kind of important.
Yeah, and I would also just add to that, be authentically curious about every human you interact with. Because I can't tell you the number of unexpected, amazing connections I've made sitting next to someone in an airplane, or sitting next to someone at a bar on a hotel trip, or, you know, watching a kid's sporting event and you realize that other parent and you have something in common and there's a link there. And I think having this collection of interesting people, I think it was JJ said, you don't know when that's going to pay dividends, but A, it makes life very enjoyable, but B, that's how you scale your network outside of just the same people. I think that's another mistake I see. People have such concentrated networks, and then they don't have these links, these bridges to the other diverse networks, and it's often through those unexpected connections that we form those very impactful bridges to another network. So this was great. All right, moving on. Yousuf, one for you to start with. In your view, in this market where times are tough, it's a lot of cost cutting, but if you're a startup, you're also tasked with growth and innovation and spending money. So how do people balance the fact that they have to make tough calls on their budgets while not shortchanging what makes the innovation that drives their venture?
Okay, so great question and very relevant in terms of the environment we're in at the moment. So there's a common thing where, you know, I meet with founders, and I'm sure collectively we'll meet, and they'll ask this question. It's a really bad environment. And they're like, oh, I probably don't want to raise money, or I don't want to start a company at this time. I'm going to give you a secret. There's no right time to start a company, okay? And the reason for that is the founders and the companies that do well in the longer term are the ones who are driven with the objective and the goal of being able to build a company of long sustaining value, right? That's important to point out. So for example, I was CIO for a company called Pure Storage. It was company was founded in 2009 in February, at the height of the financial crisis. Now, it is a data storage company. Physical data storage which goes into data centers. I guarantee it to you that no one thought that is a perfect time to basically build a physical hardware appliance company at the height of the financial crisis and put that in place. But guess what? It's an $11 billion company which went public, fastest growing systems company on record, okay? So every data point would have told you, do not start a physical hardware company in 2009 when budget doing. Same thing with Zoom. Zoom came into a place where it was in a competitive industry with well-funded competitors and probably shouldn't have basically been around, but it was much better architecture. The point is this, The way you're able to navigate companies through a difficult market, whether it's cost or otherwise, is to judiciously prioritize of what is going to make the difference for you to be able to grow your company. Specifically, that's about where you focused on revenue. There's a number of challenges that happen with early stage companies where you're able to get 5 or 10 customers and it's all great, but it's not the 5, 10 customers in the first year, it's the 15 to 20 in the next year, and it's actually the 5 to 10 in the first year that renew to go forward with, okay? And the only reason that customers will typically renew or pay, whether it's a consumer product or otherwise, is because they see value. And so I would basically advise a couple of key things. Number one is focus on what key thing which is of value to your customers, because that ultimately comes first. Second is you have to be creative. And that basically means that you have to make hard decisions about the team that is around you to be able to do that. So that's one of the challenges that typically have. I'm not saying it's an easy decision. It's actually a very hard decision to basically figure out. But ultimately, it's another day in the technology business. There are going to be up cycles and there are going to be down cycles. And there are going to be some people who are going to be a great fit for the time that you are, and there's some people who are not. Some people, it could be the best COO or the best CFO of a company, but that's not what you need right now. And I think a lot of founders have to ask the question, what do I need to be able to grow the company? What do I need to be able to consistently add value? And what will help me get through a difficult period that will help me with my fundraising going forward? So that's at least my take.
Yeah, I can add something here. I mean, really called the beginning of 2022, there was this shift in mindset from the entrepreneur and the venture capitalist saying, hey, where's the profitability? Where's the path to profitability? Switch from this sort of growth at all cost model, which over the last decade or so with zero interest rates, it was a growth at all cost model. Grow as fast as you can, continue to raise money, have that company IPO, and everybody makes money. Well, that fundamental shift really happened in, call it early 2022, it was really more like mid 2022. And then this profitability term kept on coming up inside of venture capital. And in my opinion, that went way too far for a little bit too long. And so if you look at the market right now, yes, you need core good unit economics. You need a path to profitability. But as a venture capital investor, we're investing in growth. We're not investing in companies that are going to produce income and pay dividends. We're investing in companies that are going to sell, that are going to go public, that are going to get bought by Google or Apple. That's our goal. So you can never get away from growth inside of venture capital, in my opinion. And I just feel like that pendulum swung a little bit too far towards you need to be profitable, although once again, now you need to show a much more visible track to profitability or a path to profitability. Don't throw out growth because you hear, hey, you need to be profitable.
Yeah, so being inside of an operating company that historically was always valued on TAM and growth, and in the middle of a capital raise, everything shifted as if it's like everybody started reading the book from right to left instead of left to right, and it was about profitability. And I'll say a couple different things. We're still in this marketplace. This is not going anywhere for the next, I would say, 3 to 5 years. This will be the dominant notion. So realize that and adjust to it. Don't hope for the pendulum to swing back anytime soon. The main reason is because the cost of capital is so high. So most people that are sitting on a lot of powder want liquidity, will invest much more in the public markets than they will in the private markets at this current time point, and are going to continue to do so because it's been the cheapest way to get profit in the capital markets on the public side in a decade. And so people are reaping. It's also on the private side, the best buying opportunities. So people are going to be extremely valuation sensitive when they price the model for you. A couple things that I've learned through blood, sweat, and tears in the last couple years, not only through my own company, but as a director and representing my babies, my portfolio companies going through their earlier stage raises, is that your model, the integrity of your model is basically your reputation. And the level of detail that you project your model, I was with an investor this morning who said, we have never scaled our model to match management's forecast, not in one instance, and they've invested in 1,800 companies. So just realize that. Nobody believes you. Management forecast is always going to be at expectations. So you have to build your culture to execute and win. So that means setting realistic expectations. You want to outperform those. So internally, the way you speak to your employees, the way you speak to your board, the way you operate, those are different than the way you speak to investors. And you have to balance all of those in the setting of if you're early or late stages. That's one. Don't build 10-year models. 10-year models, after year 2 or 3, you're just making stuff up. And maybe that varies a little bit, but I can tell you in healthcare, you're making stuff up. And so focus on what you're going to do this year to execute and in the next 3 years. And the last thing I will say is cash flow. So, you know, revenue, nobody really cares about revenue anymore because it's the cost of your revenue that used to not matter. That matters a lot right now. So margins and cash flow. I don't care what business you're in. Those are metrics that you need to be very versatile. And the decisions you make inevitably on your P&L to budget cut, you've got duplicity in talent. You're spending on things that you shouldn't be spending on because you're not being singular focused. Everyone wants to have a platform, right? But pick the thing you're going to dominate at, overspend on that, overspend for talent, and cut everything else in a time of famine, which is, you know, for operators and founders right now. Inevitably, you're not cutting fast enough and you're not shifting your dollars fast enough. So just realize that. Realize that nobody believes you, you're not cutting fast enough, and start to behave like that because you'll catch up. And we'll learn from this period. I pray that we're going to shift in some way, but this is actually, I think, even though it's painful, it's a super healthy correction. And one of my mentors, who I think is one of the wisest people, he always says it's the 2 Ds, dilution or distraction. Stop worrying about dilution right now. Yep. You need capital. The more you worry about dilution, the more distracted you're going to be and the more your business is going to suffer. Take the hit if you need the capital, build value, and do it with the right people and overpay the talent to do it. So,
yeah. How do you feel about plans that you see from entrepreneurs that have really thought about plan A, plan B, plan C? So with $10 million, I would do this. With $15 million, I would do this. With $55 million, I would do this. Not just the base case is 10% higher and the base case is the stretch case 10% higher base case, and then the bottom case just moving things up, but actually really thinking about showing to you as investors, I have a lean model to get to profitability. We leave value on the table, but we could do it with 5. If I found 10, I unlock more value. The returns look like this. Frankly, I don't think I've seen enough of that thinking right now, but it feels like a way to kind of bring investors maybe along. What are your thoughts about having these different scenarios presented? Or is it just too distracting?
Maybe I can start from the operator side. And So I think that, I'll go to the 2 Ds. The best advice I ever got was take more money than you think you need. But I would say I always operate a budget to value inflection. And I never want to take more money than I need for the value inflection, because if I'm thinking about it from my cap table and my shareholder value as an employee or as a founder, I want to get to the next value creation with a buffer, which is why I'm taking more money than just hitting a budget at the 0 cent. But I'm not giving 3 upside scenarios because I'm going to want to come back to the well later with more value and more leverage. If I'm an investor, I'm saying, take more of my money now. So it's a balance. I think that's a dance. It's like the 2 peacocks coming together,
Yeah, this is something I'm literally dealing with right now. We have a company that received a term sheet for a Series A. I had told them to go out and raise 12. They had said they're going to raise 20. And so they got the term sheet for 20. The lead investor is putting in 10, and now they need to go out and find the other 10. I said, well, if you would have started with 12, it would have been a lot easier to get to where you wanted to be. I think they will get the 20, but it's a balance. And for me, it's been interesting working with this company because now I'm put in a position, to your point, to work with this company to help them find their other investors, which has been great, going back to the network, using my network, finding the right people to come in there. But I typically like to see a few different plans. And then if I am already involved in the company, it's a lot easier to say, Plan A looks better than Plan B looks better than Plan C. If you're not yet involved in the company and you're a net new investor, then it gets a little bit trickier because typically when a founder will show you the plan, that plan is usually what you kind of want them to stick to, and that's the plan that you guys agreed to going into the fundraising round. So I'd say leverage the resources that you have to come up with what's the best plan for you.
There's that saying, everybody has a good plan until you get punched in the face. So the thing with startups definitively is you can be confident about a number of areas and you can build a plan towards that, but there's always going to be a bunch of unknowns. And so one of the things that I typically tend to focus very heavily on is I ask, well, if I'm presented with a plan or a set of them, the question I always ask is, what are the things that you don't know that you need to get answers to? Because I'd rather basically focus time on that. For example, I'm very sure that nobody really predicted a global pandemic. in April of 2020. There is no plan for that, okay? So, but guess what? That is the reality of how you need to be able to deal with it. There were the biggest enterprise software companies, some of them I was advising or otherwise, that had to literally call some of their biggest customers to negotiate entire contracts, okay? So those situations are on the extreme, but the reality is if you're a founder, and I have strong empathy for people who've gone through that journey, that's a pretty, it's pretty natural occurrence in the first few years of building out a company. The second thing I'd basically say is, so one is find out the things that you don't know about and be able to build out your network to be able to answer that. Because the more data points that you have, the better it is. I'm happy to talk to people. Feel free to reach out to me on LinkedIn. I'm happy to be able to talk after this as well. I think the second key thing is that there are a number of areas where actually the human potential is pretty surprising if you actually push it. So it absolutely makes sense to be able to present a particular plan. But if you think about some of the best founders in the world and the companies that they've been able to build, let's just say they've been a little bit liberal with following the rules in the guidebooks. I'm not saying I fully encourage that, and I'm a full fan of that, but the reality is they've been successful as a result of it. And the reason for that is very simple, is they had a very specific and very clear vision of what they wanted to build in a long-term company. And that requires getting somewhat creative, somewhat pushing the boundaries, and being able to actually drive to a final outcome. And so the plan helps you be able to actually provide you with some degree of guardrails. It's actually a forcing function for you to agree what you don't want to do, rather than just what you want to do as well.
I think it ties back to JJ's distraction problem, right? Like
totally.
If your plan has too many options, like, well, we could do this, or we could do that, or we might do this, or we might do that, we struggle to think that you have that ruthless focus on doing the one thing that matters.
Right.
All the other things might be great to consider should money fall in our lap, but yes, it's that one thing that matters.
Well, it's funny, when companies are doing very well, you hear about M&A opportunities, you hear about all these distractions. When companies aren't doing so well,
there's no time for that.
Yeah. I mean, you have to remember technological shift, like November 2022, ChatGPT comes out. That was a research project out of OpenAI that was supposed to be circulated amongst the AI community of a few thousand people. But because of the interconnectedness of our economy, because of social media and otherwise, it was such a huge transformation that transformed and captured mind share for 105 million people who signed up for something within 1 week, right? Anybody have a plan for that? Not really. So anybody have an AI plan? Not really. There's a reason why the .ai domain has been the biggest contributor to the state of Anguilla's GDP, because everybody wanted to have an AI domain. The reality is, those are immense shifts. What I would say is the companies need to have a very deliberate focus. You don't have to be an AI company. There are tons of companies which are not AI companies which will do absolutely well. They're phenomenal companies. If you're a biotech or a company, you should be speaking to Jennifer, that she'll be able to give you the guidance on it. That's what Silicon Valley Bank does to grow.
Both of us.
Yeah, okay. And JJ, of course. But my point is, if you have to have a very specific goal that you're aiming towards, and people often forget that. So that's why we go.
These were great. I'm mindful of the time. We don't have time for Q&A, and it would be very awkward because you're very far away. So instead, I'm going to ask everybody, literally probably 10 seconds apiece as I'm watching this counter go down.
That's fine.
One parting piece of advice. Let's leave it on a high note. What advice would you give to the entrepreneurs in this room that are just starting their fundraising for the first time? Let's just wrap around this way. So Yousuf, and then we'll end on JJ.
Oh, me?
Yeah,
oh,
start down there.
Sorry, I've been yapping on.
I know.
Apologize.
Well,
okay, yeah.
You're doing such a good job. I just wanted you to keep rolling with it.
The one piece of advice is think about the people you want around you, want to be able to build a company in the longer term. Think about, take a little bit of a walk in the woods, or if Miami, walk on the beach, and think about the gaps that exist in your team. And that, I think, is a continuous journey for a founder, an early stage company, and that always needs to be filled in.
Yeah, I would say that fundraising is no different than a sales process. So run your fundraising process like you would run a sales process. Use your CRM, follow up, create tasks, and it's a quantity game. You got to talk to a lot of people to be
Kiss a lot of frogs. So find your friends, kiss a lot of frogs.
Exactly.
JJ.
I would say asymmetrically focus on talent. I agree.
Talent.
You, like, make sure the people
Double
around
down
you
on the
are
people.
absolutely the best people, and don't settle. And if you fail fast in those people and replace them very quickly. Nothing will cost you more capital than mediocre.
Hire slow, fire fast.
Hire slow, fire fast. Okay, I'm gonna leave you with one more. Remember why you started, because it's gonna be hard. And those entrepreneurs that have an origin story about why this is the thing that they are gonna build in any market cycle, no matter what, those are the people you bet on, because those people are like dogs on a bone, right? They don't give up. So have fun, remember why you started, and thank you to my panel. We did it, 30 minutes.
Thank you.
Thank you, everybody.
Thank you to our audience.